Welcome to the Eggs Invest podcast series, where we explore smart, practical strategies for successful residential property investment across the UK. I'm Anna, your host here at Eggs Invest, and today we're tackling a topic that often gets overlooked until it's too late. We're talking about risk management and protecting your property investments. Because let's face it, buying property is exciting, but it's not without its bumps. From market drops to problem tenants to unexpected repair bills, things can and do go wrong. The good news: you can prepare for most of it. And today, I'm going to walk you through exactly how. So, let's start with a reality check. What are the actual risks you face when investing in residential real estate here in the UK? One of the most common is market fluctuation. Property values go up and they come down. Sometimes it's due to national events like interest rate hikes or political changes. Other times, it's more local. Maybe a big employer in the area shuts down or transport links change. Then there's tenant-related risk, missed payments, damage, or long void periods where the property sits empty. And of course, unexpected repairs. Roof leaks, boilers breaking down, they always seem to happen at the worst time. Another one that catches new investors off guard is regulatory risk. UK laws around rentals can change, and landlords have to stay compliant. Miss a gas safety check or an EPC update, and you could be looking at fines. So how do you prepare for all of this? Let's talk about that next. Mitigating risk is really about planning ahead and staying proactive. Start with a buffer fund. This might sound simple, but it's the difference between being a confident investor and a stressed out one. I always recommend having at least 3 to 6 months worth of expenses set aside for each property. Then, screen your tenants thoroughly. References, credit checks, proof of income, the whole works. It's worth the extra time up front. And always budget for maintenance. Properties age. Things break. Build repairs into your annual costs, and you won't be caught off guard. If you're using a mortgage, pay close attention to interest rates, especially now that they've been fluctuating. Fix your rate if you want stability, or prepare for the ups and downs of a variable one. Lastly, stay informed. Follow policy changes. Keep up with what's happening in the local market. A big part of risk management is simply not being the last to know. Let's switch gears and talk about asset protection. Because once you've made a good investment, you want to hold on to that value and ideally grow it. Start by thinking about insurance. Landlord insurance is a must. But it's not one size fits all. Depending on your situation, you might want to add rent guarantee cover, accidental damage, or even legal expenses. Then, think about how your property is owned. Some investors use limited companies for added liability protection, while others hold properties in their personal name. There are pros and cons to both. It really depends on your long-term strategy, and it's worth talking to an accountant about. Another form of protection is future-proofing the property itself. That means keeping it updated, energy efficient, and desirable for tenants. If your rental looks tired or inefficient compared to the competition, your returns will suffer over time. And let's not forget about security, both physical and digital. Make sure your properties are safe and secure. And protect your financial records and tenant data as well. That's part of being a responsible landlord in today's world. Now, let's talk ongoing management, because owning a property is just the beginning. How you manage that asset day-to-day determines how well it performs long-term. First tip: routine inspections. These aren't just about checking the walls and floors. They're about maintaining a relationship with your tenants. If something's wrong, you want to know early. Second, respond to maintenance issues quickly. Delays can turn small problems into expensive ones. A leaky tap becomes a mold problem. A loose tile becomes a safety hazard. Third, keep good records. You'd be surprised how often landlords get caught out because they didn't keep receipts, email threads, or tenancy agreements properly filed. And fourth, review your rents annually. The market changes. Your costs change. A small increase in rent, done professionally and respectfully, can protect your returns without losing a good tenant. Finally, think like a business owner. This isn't just a side hustle or a retirement plan, it's an income-generating asset. Treat it like one, and it'll reward you over time. So, to wrap up, investing in UK residential property can absolutely be a powerful wealth-building strategy. But it's not without risks. The trick is to be aware, prepared, and proactive. Let's recap. Understand the real risks, from market dips to tenant issues to legal changes. Put strong mitigation strategies in place, build a buffer, screen tenants, stay informed. Protect your asset with the right insurance and structure. And manage your property like a pro, because this is a business and you're the CEO. That's it for today's episode on Eggs Invest. I hope this gave you some fresh perspective and maybe even a few action points for your own investments. If you're enjoying the series, don't forget to subscribe and share this podcast with a fellow investor or a friend who's just getting started in property. Thanks for joining me today. I'm Anna, and I'll catch you in the next one. Until then, take care and happy investing.